So I'd like to talk today about diversification in your trading portfolio. For market neutral options traders, diversification is a very important subject because it effectively hedges your portfolio of trades if you have adequate diversification. So let's talk about the different types of diversification in market neutral options trading. A very important one is time diversification, and that's where you enter your trades at different periods related to the options expiration you are talking about. So if you're looking at the June monthly expiration right now, then you could enter today and probably be whatever it is, 70 days out from June, or you could enter in 2 weeks and then you'd be 56 days out from June, or you could enter in 2 further weeks from that, you'd be approximately 42 days out. Whatever number of days we're talking about isn't really material. What's material is that a form of diversification is to enter your trades at different time periods in relation to the same options expiration. Now, why is that important? Because the price most likely has changed during that 2-week period, and so you're getting in at a different price point, and that creates diversification for your market neutral strategy. So price diversification is, or time diversification is one of the important forms of diversifying your trading portfolio. A second one is strategy diversification. Each strategy has different behaviors, different properties. So if you're trading a strategy with a very wide landing area, so to speak, that's going to react differently to big market moves than something that has a very tight landing area. And so also certain strategies respond well to increases in volatility, others respond poorly to increases in volatility, and that's another form of strategy diversification. So by having different strategies that you're employing, you will add some diversification to your strategy portfolio. Thirdly is volatility diversification. Some strategies respond very well to a dramatic increase in volatility, others not so well. And so by having a mix of trades that have different responses to increases or decreases in options volatility, that's another important form of diversification. And finally, and the one I want to discuss today, is vehicle diversification. That means finding different trades in different underlying indexes or stocks or ETFs or commodities or currencies, which by definition are going to have different price patterns because they're different. Oil is going to act different from gold. Gold's going to act different from the SPX index. The SPX index will act different than a currency option. So a currency's price behavior. So vehicle diversification is another very important form of trading trading portfolio diversification. So let's talk a little bit more today about vehicle diversification. Ask yourself the question, am I trading all of my trades in a single vehicle? If so, you may be a very solid trader, you could be a terrific trader, but one thing you're not is diversified from a vehicle diversification standpoint. And so what can happen to you is that if that vehicle makes a dramatic move, more dramatic than other vehicles that you could have traded, then the likelihood is that all of your trades are going to be struggling on the days that that particular vehicle is making a tough move, because we're market neutral options traders. So whatever strategy we use, it depends upon the market being relatively flat or stable. If you get a big move, no matter what strategy you're in, it's most likely going to cause you to struggle. So if all of your eggs are in the basket of one particular vehicle, then most likely all of your trades are going to struggle at the same time, which is not a particularly good thing. So I'm bringing this up because this week one of our traders requested that he start a trading strategy in TLT, which is the 20-year Treasury bond ETF. And none of the traders on our desk trade TLT at the moment, so I was very open to this idea because it created vehicle diversification. Most of our traders trade either in the Russell 2000 index or the SPX index. So adding a strategy in the TLT, to me, was something I was very interested in. So let's take a look at the price charts of SPX versus RUT versus TLT. And you'll see that SPX, for example, take a look at what this did. This is about a 21-month chart going back to the summer of 2016. And you'll see that SPX was on a relatively smooth, grinding up rally, which then started to sort of accelerate in January 2018. And then, of course, we had the early February crash, which removed that spike up that occurred in January. Now we'll take a look at RUT. RUT is a little bit of a different ballgame. It's more extreme. So that in late 2016, the RUT, right after President Trump was elected, took off like a rocket. Some people call that the Trump trade because RUT represents small cap stocks. So that vehicle acted differently than the SPX, which had a more mild reaction to the election. And then the RUT, instead of continuing that pace, just sort of flattened out for the first 5 or 6 months of 2017. And then after a pullback, took off again to the upside pretty dramatically until the February crash. So that was a different pattern. SPX and RUT are two different animals, and particularly since the presidential election, they've been acting quite differently because there's a differentiation in policies related to internationally based companies versus those who have much more local domestic exposure in the US, which is primarily what the small caps are. So we have diversification between SPX and RUT, but let's take a look at TLT now. TLT is a completely different ballgame. TLT, as you can see, responded very differently than RUT and SPX did to the election, number one. And number two, more or less just channeled around in 2018 as a result of its difference from equity markets. And so this was a completely different kind of behavior than the equity markets, and therefore you can expect diversification coming from trading in the TLT versus SPX and RUT. So what that means is that now a portion of our trading desk is going to act differently than the rest of our desk on any given day. That's a good thing because that helps to smooth the equity curve of our desk. So you should take this opportunity to ask yourself the question within your own desk. Your own desk is yourself. Your own desk is your own portfolio of trades that you trade every month. Are you diversified as to vehicle? And if the answer is no, you might want to look into various different strategies that exist that trade the various different underlying vehicles. There's no shortage of underlying vehicles to trade, and therefore vehicle diversification is certainly an attainable goal, but you got to put the work in, do the back testing, the paper trading, and so forth in order to validate any particular strategy in something brand new. And then once you find that strategy, start small, because one thing you won't know is the execution in that particular strategy. So you can back test all you want, but have no actual idea what is going to happen when you get out there and actually start trading in a particular index. You may have less flexibility in that market. You may have trouble getting mid pricing. You might have to be much closer to the bid or the ask, as the case may be. You don't know, and you don't know until you get out there, and therefore you should get out there with as small as possible amount of capital so that you can then learn the ropes of that particular vehicle and the options that trade derive from that. So please think about vehicle diversification for yourself as a trader, it will help to smooth your equity curve. Thanks very much.